credit card trap. Nobody escapes. Most people think a credit card is financial freedom. A quick swipe, a few reward points, and the promise to pay later. But what if that small piece of plastic was never designed to help you? What if it was built to keep you borrowing forever? In this video, we reveal the hidden system behind credit cards and why millions of people enter the trap, but almost nobody escapes. Most people believe a credit card is a convenience, a small piece of plastic that helps you buy things now and pay later. It feels harmless, even helpful. Banks advertise it as freedom. They say it builds your credit, improves your financial reputation, and gives you access to opportunities. They promise rewards, cashback, travel points, and exclusive benefits. On the surface, it looks like a smart financial tool. But beneath that polished image lies one of the most powerful financial traps ever created. The truth is simple but uncomfortable. Credit cards are not designed to help you become rich. They are designed to make sure you stay in the system. The entire structure of modern consumer finance depends on people borrowing money they have not earned yet. When someone uses a credit card, they are not just buying a product. They are entering a financial relationship that quietly shifts power from the consumer to the bank. Think about how the system begins. The first time someone receives a credit card, it feels like a reward. It arrives in the mail with a sleek design and a generous credit limit. Sometimes it even comes with a welcome bonus or promotional offer. The message is subtle but powerful. You are being trusted with money. You are being given access to purchasing power that once required years of savings. Suddenly, things that were once out of reach feel instantly accessible. This is where the psychological shift begins. When people spend cash, they feel the loss immediately. Handing over physical money creates friction. The brain registers the transaction as a real cost. But when people use credit cards, that pain disappears. The transaction becomes invisible. A quick tap or swipe replaces the emotional weight of spending. The brain processes the purchase differently because the money is not leaving your bank account right away. It feels distant, almost imaginary. And this small psychological change has massive consequences. Studies consistently show that people spend significantly more when they use credit instead of cash. Restaurants, online stores, shopping malls, and travel websites all benefit from this behavior. Every swipe encourages slightly higher spending. A more expensive option suddenly feels acceptable because the payment is delayed. The bill will come later. Future, you will deal with it. Banks understand this behavior perfectly. They have spent decades studying how consumers think, feel, and react to financial decisions. Credit cards were not randomly designed. Every detail exists for a reason. The minimum payment option is one of the most powerful examples. When the monthly statement arrives, the bank does not demand the full balance. Instead, it offers a much smaller number. This minimum payment creates the illusion that the debt is manageable, but the mathematics behind the system tells a very different story. Paying only the minimum balance means the majority of the payment goes toward interest rather than the original debt. The balance barely moves. Month after month, the debt lingers, slowly shrinking but never disappearing. What looked like a small temporary purchase quietly turns into a long-term financial obligation. Interest is the engine that powers this entire machine. Credit card interest rates are among the highest in the financial world. In many countries, they can exceed 20% annually. That means every dollar borrowed begins multiplying over time. A purchase that originally cost $100 can easily become $200 or $300 by the time the balance is finally paid off. From the bank's perspective, this is not a problem. It is the business model. Credit card companies do not make their largest profits from people who pay their balances in full every month. Their most valuable customers are those who carry balances year after year. These customers generate a constant stream of interest payments that continues indefinitely. And once someone falls into this cycle, escaping becomes extremely difficult. The debt grows quietly in the background while everyday expenses continue. Rent, groceries, fuel, medical bills, and emergencies keep arriving. When cash is tight, the credit card becomes the easiest solution. Another swipe temporarily solves the problem, but it also deepens the financial hole. Over time, the credit card stops being a convenience and becomes a safety net. People begin relying on it to maintain their lifestyle. Vacations, gadgets, clothes, dining out, even basic necessities can slowly migrate onto the card. The balance grows not because of one large purchase, but because of dozens of small decisions that seemed harmless at the moment. This is the quiet brilliance of the system. It rarely feels dangerous while it is happening. There is no dramatic moment when the trap suddenly closes. Instead, the pressure builds slowly. Month by month, the interest accumulates. Minimum payments keep the debt alive. New purchases expand the balance, and the borrower continues moving forward, unaware of how deep the hole has become. Eventually, the numbers start to reveal the reality. The monthly statement shows a balance that feels heavier than expected. Interest charges appear as an additional cost that never existed when the purchase was made. The minimum payment rises slightly each month, demanding a larger portion of income. What once felt manageable now begins to create stress. At this stage, many people try to solve the problem the way the system encourages them to. They apply for another credit card with a balance transfer offer or a temporary lower interest rate. On the surface, this seems like a clever strategy. Moving the debt to a new card creates the illusion of progress, but in many cases it simply resets the cycle. The original debt is still there, only rearranged. The credit card trap is powerful because it blends psychology, mathematics, and convenience into one seamless experience. Consumers feel empowered while the system quietly shifts control. Every purchase strengthens the relationship between the borrower and the lender. Every interest charge reinforces the structure that keeps the system running. And the most unsettling part is how normal it has become. Millions of people carry credit card balances every single day. For many households, it is not an emergency, but a permanent financial condition. Debt becomes a background noise of modern life, something people learn to live with rather than escape. But once you understand how the trap works, the illusion begins to crack. The shiny piece of plastic no longer looks like freedom. It looks like what it truly is, a carefully engineered financial tool designed to keep money flowing in one direction. And that realization changes everything. The deeper you examine the credit card system, the more unsettling it becomes. What initially appears to be a financial tool slowly reveals itself as a mechanism designed to keep consumers locked into a cycle of spending and repayment. This cycle does not rely on force. It relies on behavior. The system works because human psychology makes it work. Every month, millions of people open their credit card statements and experience the same quiet shock. The balance is higher than expected. Interest charges have appeared again. The minimum payment is slightly larger than before. Yet, despite this discomfort, most people continue using the same card that created the problem in the first place. This contradiction is not accidental. Credit cards thrive on the gap between intention and behavior. Most people fully intend to manage their spending responsibly. They plan to pay the balance quickly, avoid interest, and use the card only for convenience. But real life rarely follows perfect plans. Unexpected expenses appear, income fluctuates, emergencies happen without warning. When these situations occur, the credit card becomes the easiest solution. It offers instant relief without requiring immediate sacrifice. A repair bill, medical expense, or sudden travel cost can be covered with a simple swipe. In that moment, the credit card feels like protection rather than danger. But the protection comes with a hidden cost. Every time the card solves a short-term problem, it quietly creates a long-term obligation. The balance grows while the borrower focuses on more urgent concerns. Interest accumulates silently in the background, transforming temporary solutions into lasting debt. Over time, the financial pressure begins to reshape decisions. Money that could have been saved or invested must now be used to service the debt. Opportunities shrink as a portion of income disappears into interest payments. The borrower works harder, earns more, and yet a part of their financial progress flows directly to the lender. This is why the credit card trap is so effective. It does not feel like a trap while you are inside it. The payments are manageable enough to avoid immediate crisis, but large enough to slow down financial progress. People remain functional, employed, and productive while a portion of their future income has already been claimed. Banks understand that this balance is crucial. If the pressure becomes too intense, borrowers might default. If it becomes too light, borrowers might pay off the balance completely. The system operates most efficiently in the middle, where the debt survives but rarely disappears. Technology has made this process even smoother. Online shopping, digital wallets, automatic payments, and one-click purchasing have removed nearly every barrier between desire and spending. A purchase that once required physical effort can now be completed in seconds. The convenience feels revolutionary, but it also accelerates the speed at which debt can grow. Marketing plays another powerful role. Credit card companies spend billions of dollars promoting rewards, travel points, cashback offers, and exclusive privileges. These incentives are carefully designed to keep people using their cards more frequently. Every reward encourages another transaction, and every transaction strengthens the cycle. What many consumers do not realize is that rewards are not free gifts. They are funded by the very system that encourages spending and interest. The benefits exist because the majority of users eventually pay more in fees and interest than they receive in rewards. Another hidden layer of the trap is social normalization. Debt has become so common that it rarely triggers alarm. Conversations about credit cards often focus on limits, points, and benefits rather than the cost of borrowing. Carrying a balance is often treated as a normal part of adult life rather than a financial warning sign. This cultural acceptance keeps the system stable. When everyone around you uses credit cards, the behavior feels natural. The risks become invisible because they are shared by millions of others. The trap blends seamlessly into everyday life, yet the long-term impact can be enormous. Years of interest payments can consume tens of thousands of dollars that might otherwise have been invested or saved. That lost money represents opportunities that never materialize, investments that were never made, businesses that were never started, financial independence that remains permanently out of reach. The most powerful realization comes when people understand that the credit card system is not built around individual success. It is built around collective participation. The system depends on millions of consumers carrying balances, paying interest, and maintaining the flow of money toward financial institutions. Once you see this structure clearly, the narrative surrounding credit cards begins to look different. The marketing language of freedom and flexibility starts to reveal its deeper purpose. What appears to be empowerment often functions as dependency. Escaping the trap does not happen instantly. It requires awareness, discipline, and a willingness to challenge habits that modern life constantly reinforces. It means questioning purchases that once felt automatic. It means recognizing that convenience often carries hidden consequences. Most importantly, it requires a shift in perspective. Credit cards are not magical financial tools. They are borrowing instruments with extremely high costs attached. Treating them casually can quietly reshape the future of anyone who relies on them. The people who eventually escape the trap do something simple but powerful. The moment people begin to understand the credit card system clearly, something interesting happens. The entire financial landscape starts to look different. What once appeared normal suddenly reveals patterns that were invisible before. Purchases that felt harmless now carry a deeper meaning. The convenience that once felt empowering begins to look like a carefully designed mechanism of control. The credit card trap is powerful not only because of interest rates or minimum payments, but because it quietly changes how people think about money. When someone begins using borrowed money regularly, the line between income and debt slowly fades. Spending decisions stop being limited by what a person has earned and start being influenced by what a bank is willing to lend. This shift is subtle but extremely important. In a traditional financial mindset, people spend money they already possess. They earn first, then spend later. But credit reverses this sequence. It allows people to spend first and worry about earning later. On the surface, this feels like flexibility. In reality, it creates a financial timeline where future income has already been promised away. This promise shapes the future in ways many people never realize. Every dollar borrowed today becomes a responsibility for tomorrow. The more debt someone carries, the more their future income is already committed before it even arrives. Paychecks that should represent progress begin to feel smaller because a portion of them is already reserved for past spending. Over time, this dynamic quietly limits financial freedom. Opportunities that require risk or flexibility become harder to pursue. Starting a business, changing careers, or investing aggressively becomes more difficult when a person must maintain steady payments every single month. Debt does not just affect bank accounts, it shapes life decisions. Many people believe that the solution is simply earning more money. At first, this seems logical. A higher salary should make debt easier to handle, but the reality is often more complicated. When income rises, spending habits frequently rise with it. Larger homes, newer cars, better vacations, and upgraded lifestyles absorb the additional income. Credit cards remain involved, quietly expanding to support the new standard of living. This phenomenon is known as lifestyle inflation. It creates the illusion of progress while maintaining the same financial pressure underneath. A person who earns more but spends more often feels just as constrained as before. The credit card balances may grow larger, the limits may increase, but the dependence on borrowing remains. Another powerful force within the credit card system is time. Interest does not operate dramatically, it operates patiently. Small balances can grow steadily when interest is applied month after month. What begins as a manageable amount slowly expands as interest compounds over years. Because the growth happens gradually, many people underestimate how large the total cost becomes. A purchase made years ago may still be affecting someone's finances today. The original item might have lost its value long ago, but the financial obligation continues. This disconnect between the lifespan of a product and the lifespan of the debt is one of the most overlooked aspects of credit card borrowing. The system also benefits from something deeper within human behavior: optimism. People naturally believe their future will be easier than their present. They assume they will earn more, manage money better, or resolve the debt quickly. This optimism encourages borrowing because the consequences feel distant and manageable. But life rarely follows predictable timelines. Unexpected events can disrupt even the most responsible plans. Job losses, health issues, economic downturns, or family emergencies can instantly transform manageable debt into overwhelming pressure. When that happens, the credit card that once felt like a safety net becomes an additional burden. At this stage, the trap becomes clearer. Payments are no longer optional choices. They become obligations that must be met regardless of circumstances. Interest continues accumulating even when income stops. Financial stress begins affecting not only bank accounts, but also mental health, relationships, and long-term security. And yet the system rarely presents itself as a danger. Advertisements continue highlighting rewards and convenience. Banks continue offering higher credit limits, encouraging more spending power. Promotional messages focus on opportunity rather than risk. The narrative remains positive because the system depends on participation. But awareness changes everything. The moment someone truly understands how the credit card structure works, they begin to see choices differently. A purchase made with credit is no longer just a purchase. It becomes a commitment that extends into the future. Every swipe represents a small claim on tomorrow's income. This understanding does not mean credit cards must disappear completely from a person's life. What it means is that the relationship with credit changes. Instead of viewing credit as extra money, it becomes what it actually is: borrowed money with a high price attached. People who escape the trap often follow a similar pattern of realization. They begin paying closer attention to interest charges and total balances rather than minimum payments. They recognize that the fastest path to freedom is eliminating the balance entirely rather than maintaining it comfortably. They also start questioning the cultural narrative surrounding debt. Modern society often encourages spending as a sign of progress. New purchases are associated with success, comfort, and achievement. But the hidden cost of this mindset is the quiet accumulation of financial obligations that restrict future choices. When someone breaks away from that mindset, something powerful begins to happen. Money that once disappeared into interest payments begins to remain in their control. Savings start to grow. Investments become possible. Financial decisions shift from reacting to debt toward building stability. This transformation rarely happens overnight. Escaping years of accumulated debt requires time and persistence, but the shift in awareness is often the most important step. Once people recognize how the system works, they stop playing the game in the same way. Instead of chasing rewards, they focus on reducing balances. Instead of expanding spending, they strengthen financial discipline. Instead of accepting debt as normal, they begin treating it as a temporary condition that must be eliminated. The result is a gradual return of financial control. Each payment reduces the influence of past borrowing. Each decision to avoid unnecessary credit weakens the trap further. The process can feel slow, but its impact grows steadily over time. Eventually, a point arrives where the balance disappears completely. The credit card remains a piece of plastic, but its power has changed. It no longer represents a source of borrowed income. It becomes simply a tool that can be used carefully or ignored entirely. At that moment, the illusion surrounding credit cards becomes fully visible. What once seemed like financial freedom was actually a carefully structured dependency. The trap was never about a single purchase or one moment of bad judgment. It was about a system designed to normalize borrowing as a permanent way of life. And once someone steps outside that system, they begin to see something most people overlook. Real financial freedom does not come from access to more credit. It comes from needing less of it. That realization is what finally breaks the credit card trap.